This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Charles Hugh Smith. Charles is a well-recognized writer on the web, and as we talked about here just the other week, a recent author once again. Charles, welcome.
Thank you, Gordon.
Charles, I was thinking as I was saying that, how many books now have you written?
I think there's 5 or 6. I lose count myself.
Could I say there's quite a few here because we've only discussed the one here recently, which is in our library. But I know you have them all listed on your website for those of our listeners who may not be familiar with your work. Charles, what I wanted to talk about here this morning is themes for 2013. I'm about to come out with our thesis paper at Gordon T. Long for the year. We publish it once a year, and so we're doing a lot of work on it, and we'll be sharing that in January. But I wanted to get a sense of what you think the themes are going to be in 2013. And I know you brought some great slides with you this morning, and I know you also had to distill them down here for the sake of time. But I wonder if you could take us through them.
Be glad to. The first one, Gordon, is on systemic fragility. And we have discussed this indirectly over the past year, that as systems become more untenable and more unsustainable, then on the surface things can look quite stable, but beneath the surface the odds of a breakdown are slowly climbing. And in nature, an earthquake is a pretty good example, that the tension beneath the surface slowly builds between these conflicting plates. And on the surface, everything looks fine. And then suddenly there's a massive earthquake. And everyone says, gosh, where did that come from? But the system beneath the surface was building up this tension for months or years and decades. And I think that's a fair metaphor for our financial system.
This chart, for those who are technicians, this rising wedge, it's a classic, what they also refer to as an ending diagonal. And you see it in the financial markets. And then once it breaks that lower trend level, you're into a whole new trend that's no longer up, or it's down. And of course, this can work in reverse. And it breaks, and it tests it so many times. But when it breaks, it then breaks it and breaks it hard. And it's amazing how it overlaps. And I've got to believe a lot of it is primarily sentiment and attitudes, and attitudes that when the system is fragile, that it will break. And what's wrong with the attitude is there's this sense of complacency and everything's fine. And then there's this realization suddenly, as I think I'd mentioned to you once before, it's kind of called an oh God moment. Oh my God, what happened? And it suddenly breaks, and the attitude changes and the sentiment changes.
Yeah, and I think that I mentioned here in the chart the ratchet effect, and I think that everyone that's works within an institution or deals with an institution knows that. And that's that pretty soon there's an extra layer of staffing, and there's an oversight committee, and you need 12 secretaries for 10 doctors. And like, say, for instance, healthcare. We now spend almost 20% of our GDP on healthcare, $2.3 trillion. Well, it gets more and more fragile as those costs rise, because everyone within the system goes, well, if we take a 5% cut, our system breaks down. And so we can see the threshold of vulnerability, if you might call it, keeps rising as the cost structure rises, to where these systems, you can't cut them by 15 or 20%, because they'll break. They're that fragile now because they require this vast cost structure. And when corporations do that, then they quickly implode and they go bankrupt.
We went to this globalization worldwide. We're all familiar with it. But the system has become extremely complex. We all know that. And complexity, whether we're in the financial system, whether we're talking about supply chains, and with complexity becomes dependencies and interdependencies. And what these systems are is they're fragile. and something breaks and it cascades, they're not robust. An old engineer, I used to test systems. You had to design them so that they were robust, and that is, you had to design them for what happens when something breaks. That it wasn't cataclysmic. In fact, there was some kind of fail-safe backup. And what's happened with our systems, and certainly your whole theme, Charles, of financialization, is we've got so much complexity that is fragile. It's not robust, that something will break, because something always breaks. But there will be no backups, and it'll cascade. And I think we saw it in 2008. We saw it after the dot-com bubble. And this is before we went to the levels of securitization. And I think that a lot of professionals today sense that. They sense that and they feel it. But there's not much you can do until something breaks.
Yeah, we just have to anticipate that there'll be, quote, unexpected breakdowns.
Especially when we go to the level and when we're into completely and totally untested monetary policy around the world. We're using different techniques, not only untested, to solve problems that I question whether in fact even belong in the monetary field.
Absolutely. It's trying to slice an apple with a sledgehammer. I mean, it's just the wrong tool at the wrong time. And so this slide is called "The Fed Loses Political Capital," because, all central banks claim to be independent. The Bank of Japan, the European Central Bank, but they are all working within a political system, and the pressure on them can become extremely intense to either, ease more, create more liquidity, or pull in their horns. Once it's recognized they've failed, then there's going to be intense political pressure on them to either do something that they can't do or admit the failure. And I think that, with the Fed's actions, there's a huge diminishing returns here. Every new QE, the effect is much shorter, and then it quickly rolls over. And my gosh, look what happened in December 12th. I mean, they announced so-called QE4, and the market's declining the next day.
Exactly. As a matter of fact, some of by the end of the first day, and we've never seen that before. So every one of the, this is quantitative easing 4. Every time it's been less impact and a shorter duration, but conversely, the operations have been bigger and more money put in. And this is $85 billion a month that we're talking about on this one. $1 trillion this year, minimum increase in the Federal Reserve's balance sheet alone. And what are we getting out of it? Almost nothing in terms of reaction.
Right. And so what happens when the U.S. economy rolls over into recession in 2013, which, everybody with any grasp of data knows is going to happen? Then the Fed will be revealed as a failed institution and its policies as dysfunctional and actually counterproductive.
And that's when hope turns to fear. And our society in general, who are putting ill-founded hope and faith in the monetary policy of the Federal Reserve to fix a problem that doesn't belong in their court to be fixed. And they're going to turn and they're going to realize it's not working and there's no other solution. And that's going to just absolutely crush sentiment. And I suspect it's starting already to happen, but it'll be a, oh my God kind of moment.
Yeah, and absolutely. Another topic that doesn't get a lot of media coverage is the social consequences of economic stagnation. I think we're going to see more of this in 2013, the recognition of what I call permanent adolescence, that when you present the younger generation with fewer and fewer opportunities for a decent living and a career, they revert to a state of permanent adolescence. They live at home into their 20s and 30s. They give up their long-term goals of marriage and having a family. They become obsessed with childish video games and pop culture hobbies. And if we say, well, what evidence is there for this? Well, we can look at Japan. And this is exactly what's happened in Japan. After 20 years of diminishing opportunities for young people, an entire generation of people are just living at home, giving up marriage, work part-time, and just indulge in these kind of pop culture fantasy-type hobbies. And that's a sad statement, and of course it's terribly destructive to the to society and economy.
I think this is actually a profound observation that you're making here, Charles, and especially using Japan as as a precursor of what's going on, because clearly this is happening. I mean, let's just pick on housing. With the millenniums, if you would, facing the student debt loans that they have, not being able to get jobs and earning a sufficient income to offset the debt, so they're not buying houses, or if they are, it's at a much later stage. So that underpinning of our society, where housing has become so important to our society, and its ability to finance extraction of some wealth for 75 million baby boomers that are wanting to retire. This shift in attitude is truly significant, and it's not a nice thing to talk about. It's a mandatory thing to talk about. They have a whole different level of motivation, and it's not a criticism of them. It's the opportunities that they have. They're discouraged. Look at in Europe with an unemployment rate of 50% of the youth. They're frustrated, angry, and they've invested in their education. They want to do something, but they can't find any opportunity. It's self-reinforcing.
Yeah, no, that's absolutely right. It's not these people's, it's not their choice. It's that they're frustrated and they don't see any other choice. And let's move to the next slide, which is some data points here for the United States. And we can see that in the 18 to 34-year-old range, 35% have gone back to school. And as you and I both know, Gordon, many of these people are borrowing immense sums of money to do so, digging a big hole for their future. And fully a quarter of them have moved back home. Those are profound trends.
They're not short-term trends, but they have long-term significances to our economy. They're not acquiring the skills that that you do. You know, when you're in your 20s and your 30s, the first few jobs that you have, those 10, 12 years, there's a lot of formative learning that happens, and skills and knowledge that if you're banging from internship to internship with instability, or not even be able to find that, you're robbing your society. And that's what's going on right now in real time.
That's an excellent point. And it's sad. And yet, you know, and we'll talk next year about the future of work and the nature of work in a changing economy. The next slide it looks to me like there's a very high probability of a major stock market decline in 2013. And we could do several shows on this, but this one chart is just the Coppock curve killer wave, and as one technical example. And it looks like we're headed toward some kind of major decline over the next year, if you just look at this one chart. And of course, there's other evidence as well.
I've done enough technical analysis that everything is indicating that to me, Charles. At this point, technical charts do change, sentiment change, but everything to me says sometime in 2013, the secular bear market will resume in nominal terms. It's still been sustained in real terms, and the market has been falling steadily in real terms since 2000, but we'll see it in nominal terms. At least that's what the charts are showing me as we talk here in December.
No, I think that's absolutely right, and we can talk more about that next year. The next slide is on the velocity of money. And for those people that aren't familiar with that term, it's sort of like if you go borrow $100 from the bank, and if you stick it under your mattress, that's dead money. The velocity of that money is zero. Whereas if you go out and you spend it, and the person that took the money for the good or service then spends some of that, then we can see that the money flows through the economy at a high velocity, and growth tends to come with velocity of money. And so if you've got very little velocity in your money, you have very little growth. You have a lot of dead money laying around, and that is precisely what this chart says. The Fed has created a lot of money. It's thrown a lot of liquidity into the economy and into the markets, but increasingly, the money is going nowhere. It's sitting in the Federal Reserve itself, you know, by the banks putting it in the Fed, or it's sitting around languishing. It's not being spent or invested. And that shows the Fed policy has failed.
It shows something else too, Charles. I think you could read this as it shows fear. Because when you're printing and putting as much money out, or at least creating as much liquidity and available credit, that we should be facing elevated levels of inflation, potentially, possibly even hyperinflation. This chart should be going the other way. So when it falls off to this degree, it says that people are either terribly afraid, and that's why we see the money on the sidelines growing at an ever-expanding level as the volumes in the stock market have just plummeted. The money is going to safe havens, And it also shows that they can't find good investments that are risk-adjusted investments. That is, there's so much malinvestment and mispricing out there that to find anything that is going to give you some sort of yield, you're taking on way too much risk. So that it's better to sit on the sidelines and to try and the return of capital versus the return on capital mentality. And that's what this chart is suggesting to me. I may be misreading it, but that's what I see in it.
No, that's an excellent point. The risk-return ratio is just abysmal. You know, that you're taking on enormous risks if you go into risk assets for a modest yield. And then if you avoid risk, you have basically no yield.
This is the whole basis of financial repression, is you drive down yields and you penalize savers, and you effectively finance your government at lower rates as you transfer wealth. That is the devaluation of the value of money as a store of value, and you transfer the wealth to those who are the printers of the money. And this is what we have going here. And unfortunately, this game does not end well.
Let's move to the next slide, which is related to the velocity of money and the malinvestment, is that this is household income. And we can see that in nominal terms, it's risen by about 24% since the year 2000, meaning that on face value, it looks like everybody's paycheck grew by almost 25%, which would look solid. But adjusted for inflation, it's actually fallen by 9%. And I want to make a point here that's not displayed on the chart, which is that about 50% of all household income goes to the top 10%. And so, which in the top 5% or so have typically seen the only growth in income over the last decade. So what this chart is actually showing is the middle class. In other words, all the people beneath the 10%, the bottom 90, have probably seen their income decline by more than 9%. And this is the result of the Fed's policies and financial repression. You know, declining income.
Squeezing disposable income, which is a reduction of your standard of living on an ongoing process to finance an over-indebted sovereign. It's a classic. It's a foundation of what they refer to as a macroprudential strategy, where the government steps in to try and stabilize the finances of the country and the government, and they use this technique, and it's called negative real rates. To you, it ends up translating into crushing reductions in your disposable income, and this chart clearly shows that.
Yeah. And I think that this chart is on small business. The engine of growth is in structural decline, and I think that this relates to the topic you addressed a moment ago, that the opportunities for business are just not there. There's too much risk. There's too much regulatory costs. There's too many taxes. And so what's the yield for risking all your capital and all your life, you know, your time and your energy? They're just not there. And so I'm not at all surprised that business, the number of businesses per 1,000 Americans has just literally fallen off a cliff since 2006.
There's so much uncertainty out there, whether it's regulatories, whether it's taxes, the changing policies, that the creator of wealth and jobs in America is small to medium-sized companies, primarily small. And they're having to take on so much risk, and they don't see the growth right now. And I was listening to one person who does a lot of touring and a lot of public speaking, and he said he's noticed in the last 6 months how many people have come up to him after shows to talk to him, to compliment him on his speaking, but to talk about what they're having to do with their business. And he said the majority of them were second, third, or even fourth generation owners, family-owned businesses that were now facing the kinds of problems, and as they said to him, in the new year, we'll probably be selling the business. And that is, they've decided that the return is no longer there for their risk, or they're not being able to make a go of it. And the other thing that he was hearing was that they were saying how many of them were aggressively moving from full-time workers to part-time workers, primarily because of Obamacare. As an incentive there, which was very, very troubling to them, because these are in many ways family businesses and small businesses. There's a strong loyalty to their employees, but the realities is they can't make a go of their business. They're getting just crushed in all ends of it, and they can't get the growth. They just don't see the growth. There's uncertainty. And Charles, what I'm also seeing is what's really amazing is you have this tremendous uncertainty. And so the business optimism sentiment has been plummeting, absolutely plummeting. Capital expenditures have been plummeting in this regard. But up until very recently, sentiment and confidence from the consumer has been on an upscale. It had been going up, but in last month's Michigan, it suddenly turned around and plummeted down as the realization has started to set in.
Yeah, and I think that it's important to say there are bright spots. Say, for instance, in the energy field, if you've got a small firm that makes equipment or parts for the energy sector, your business is booming. You're adding people. But, that's the energy sector. And then we can say, okay, social media and mobile software. Engineers are commanding $90,000 a year that can write mobile apps. But these businesses are relatively small. And my example is always Twitter, which is a global company with global reach, a fantastic social media company. And I believe it has maybe 800 employees. I mean, it used to only have 400, and I think they doubled. Well, that is nothing. That would barely fill one floor in one office tower. So, the idea that we need 20 million jobs, you're not going to get it from social media or software. It just doesn't create that kind of jobs. And energy is a positive bright spot, but it also can't create 20 million jobs. It might create 200,000.
That is a huge issue. The internet, which I'm as big a proponent as anybody, is Schumpeter's creative destruction of jobs. It's been so powerful, reducing so many different types of workers, clerical workers, secretaries have just disappeared out of our lexicon here in the last 10 years. We had factories of 100,000 people. They're just gone. But those jobs are not being replaced. I live in a high-tech area here up in Boston, and, the bigger companies are 4,000, 5,000 people. They're not the 200,000 a deck we used to have in Prime and Data General and all of these. So the nature of work has changed. It's not coming back. So on a positive basis, we're seeing an explosion in small little startup idea companies in the biotech area up here. They're downtown Kendall, the Kendall Square area. They're everywhere, but they're 3 people, 6 people, all look with a new idea, a new concept. Now, 90% of them die, but if 1 or 2 of them make it, then it's a positive. Unfortunately, when they make it, it's still a small amount of people that they end up hiring. It's, measured in the hundreds, not measured in the hundreds of thousands. That's the problem we're grappling with. We're up against our hard line, Charles. Well, last question for you before we break. Has there been any surprises in 2012 that's just passed that were very unexpected and surprised you?
I think the lack of crises, if you will. In other words, I was expecting some earthquake-type tremors in the global economy, and yet really it's been steady as she goes. And so every crisis in Europe or China or the U.S. was quickly papered over. And so that surprised me, that we got very few tremors despite the underlying tension and fragility that we discussed.
Yeah, I've been surprised that, I wrote a whole series of papers on extend and pretend, and I was surprised how well it worked. And then as we went into kick the can down the road, and it kept on working. And then recently we've been into fake it until you make it, as we pretend with all sorts of distortions, and we referred to that whole series we did on monetary malpractice, that it's been able to sustain itself, and to use your expression, we've been able to paper it over. I'm amazed that something hasn't broken or fractured to really hurt the system sooner. And maybe that's a good thing, Charles. Maybe we bought enough time, and maybe 2013 will turn out to be a much better year than we're currently looking at. I think the themes that you've outlined here, there's a show or a multiple show next year on these, and a lot of them that are going to be emerging. So I'm really looking forward to 2013 with you. So with that, any last comments, and how could our listeners learn more about your work, your writings, and the things you're involved with?
Please visit me at of2minds.com. And thank you, Gordon.
Looking forward to a great 2013. Talk to you later.
Okay.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.